Talk to me honestly. I'm here. I'm here. Talk to me. I'm here.
What's up, everybody? Good morning. Interesting overnight. I can pull back just a little bit. I'm at par before the CPI, same prices. Looks like the Russell's pulled back a little bit harder now as it's hanging a little bit higher. More sector divergence today, which is extreme amounts of sector cycling, people rotating into tech. Again, back flipping the market. What up, what up, what up? Good morning, y'all. All my friends. CPI today. Double Sims numbers. Oh, music's real loud. My bad. Hold on. I forget. My bad. Good morning. CPI came out this morning. Jobless claims numbers. Initial jobless claims came in a little bit higher than expected. That was a miss. Continuing jobless claims came in slightly under, but still kind of flat-ish. Core PPI. Moving the market. The market. Oh. It's ready to go. Gonna end the intro song. I could have started earlier. Had a late start today. Let's go. Major release on the test server today. Talk about that in a little bit. All right, let's go. Okay, looks like SPY. We are opening. We're gapping down a little bit. Let's take a look. Resilience opening slightly positive in the S&P, slightly negative on NASDAQ. The initial downside move. We got our calculations come through here in just 1 second. Let's go. Let's go. Smash that like button, everybody. Ooh. Bear long up right at hedge pressure. Something I don't dislike. Resiliences are negative, though, so we got resistance here, support here. We need to get resilience. Holding the fort really quick. Okay. Irrational. Nope, nope, nope. Double check. Picture's good. Still above triple B, so we're going to have some volatility and pivot overshoots, so be very careful. Today could be a hedge pressure break day. Very careful. We have SPY right on the edge right there. About to tap and touch. QQQ coming in and bull long up. Bull long up is support 325. Good, good, good. So today, with the Q being the stronger of the two, actually, Q is actually weaker now. We're gonna look for challenging hedge pressure holds here. So we're gonna wait till DD number comes out. Hopefully DD stays positive here. We get a nice clean bounce of a hedge pressure. We'll see how that works. The Russell really quick. Bear short up right on liquidity maps. Pull it up. Bear short up is pressures between the two hedges. And we are clearly downside here. So we have some good supports coming up. IWM here. UQ now pressing hedge break, 2 red lights in a row. I'll check this. Yeah, not looking so good. RES is negative. DD 95. DD's still good. DD's, let's see if it pulls down. It could be a nice little hole in Qs. Ooh, that's dropping pretty quick. So we have PPI numbers come out today, and that could be a catalyst for the, or not a catalyst, but like a sentiment changer. Okay, the question is, with resilience as being negative, we're kind of resisting half gaps. So not liking what I see there. Keep an eye on Russell. If anything breaks through monthly hedge pressure, that's going to be the bigger problem. Just keep an eye out for Russell hitting monthly hedge pressure and breaking through. QQ today. Closer to bottom DD bands. Take a look at this. SPY. I'm just gonna estimate DD bands somewhere in there. I love days like this. You have irrational days, but remember, watch DD. It's changing very rapidly. It's gone from 9.5 to 9.7. This could be a sentiment change day. So I think drops below 0.6. My confidence in the bull side is gonna completely deteriorate. Plus upper DD band is right about here, so it inched up against it overnight, which is interesting to see. So be careful here. Bear short up is resistance against hedge pressure could fall all the way to DD band. That's about 41.20, give or take. Be careful here. Resiliences are negative. Yeah, and today's probably going to pull down pretty hard. Not crash out, but at least interact with lower DD. It's like on the surface, QQQ is like the stronger of the three, and we're going to make sure that it doesn't break through its hedge as well. So it's dancing there right now, but looks like it's doing it. So DD bands down here somewhere. We also have a lower gap to be filled. Looks like on the downside. Let me make sure while I'm here, I'm going to mark some of my gaps. Not doing anything yet. Welcome, guys. Hit that, smash that like button if you don't mind. Hit it good. Perfect. Okay. Quick look at the fundamentals that came out today. Continuing jobless claims. We talk about this one a lot. First of all, PPI comes through. It's this is the core right off the surface. The PPI core excludes food and energy. You can see that number has been coming down. So again, inflation on the front end of the logistical chain, supply side is looking good. And things are coming down slightly better. That's the CPI from the other day. Let's go back and pull up that PPI 0.2. DD still 0.76. Okay, let me see what I got here. Coming in at 0.2. This is the month over month. Price of goods sold by manufacturers, right? So the top is kind of floating zero. The inflation portion of the front end of basically the cost push inflation, the front end side of goods and materials, those prices have been coming down. So the cost push inflation effect is practically non-existent anymore. It's almost back to pre-COVID era levels. So right now we're experiencing that secondary type of inflation. It has to do with the mechanics of the recession and lack of productivity and all those other things that are plaguing the economy now. So we're kind of out of that first wave of what caused an initial inflation to begin with. These aren't necessarily terrible signs. This is not huge beats, kind of coming at par, these things. So the jobless claims, 4-week average, still coming in pretty high. People aren't getting their jobs. That continued jobless claims still holding the fort pretty high. Yeah. So the same mechanics of what's been causing on the consumer side of things, people are unemployed without money, like essentially without lots of spare money to spend these days, and credit's hard to get. So economy's just generally slowing down. This is normal recession mechanics. Oh no, does this gap, let me see if this gap actually did fill. I think it did. Let me double check. I still don't want to touch everything. Yeah, we have breaks here. The patch is coming out tomorrow. A bunch of cool features. I'll detail those a little bit. Let me go back and double check some of the. How far back do I need to go? I came close. Why am I on 1 minute? Go to 3-hour chart. Yep, careful with hedge breaks. So no action yet. Like I said, I want to get that nice clean break. Resiliences are negative. Let's take a look at some of the Let's see if we have MHP breakdowns. I'm just going to make sure there aren't any big stocks coming through and crunching through their monthly hedge pressures. Okay, let's do a monthly map still. We always have to make sure we understand our monthly maps. And also in here, I'm going to go through here and double check. Welcome to the Rocket Scooter stream. Good morning. Everybody, smash the like button. Scroll down, hit that like button. Y'all have one job every morning, and that's the best job in the world, I promise. Every time you do that, something really awesome happens. Promise. Just click it. There's a little like button there. The algorithms love you. I love you. My cats love you. Need some mark up all these little gaps here. So these are exit targets, right? Anytime you're trading internal, you always want to make sure you're marking up your gaps. Shooting yesterday. All right. Okay. The monthly map, right? We're getting a little bit of noise in here, but the bull side is still strengthening, bear side still weakening, still looking good on SPY. The short squeeze still continues. QQQ is still looking pretty. Hold on, wait. Actually, I can't see it yet. There we go. Still looking pretty much the same. I didn't expect it to change too much. Anytime that those gray boxes are coming down, at the bottom of the gray boxes are coming down, bull side is strengthening as the days go by. Anytime those light gray boxes, tops of them are coming down, bear side is weakening. Shorts are exiting, longs are getting longer. So we'll check the risk on the Russell. Clearly is going to be a the weaker of the three. The small cap is getting a lot more heat. Just because it's the risk, or actually not like well heat, it's getting like less. There's less, I would say, strength there, or more people short, and like less people covering. More people are just not taking that, and that's traditional in a recession. People tend to risk in on more stable things, and risk in to like a lower risk. Sorry. Risk in or get long or get in on a trade on the riskier stuff last and the stable stuff first. So they get into like blue chips and then smaller caps and then crypto, then NFTs. You know, people long riskier stuff as the market appears safer. People get out of the riskiest stuff first. People dump NFTs. NFTs crashed, cryptos crashed, small caps crashed, and then now blue chips crashed, right? Or not crashed, but like sold off. And then all of a sudden the market's stable, and so you're going to see the blue chips come up first, and then the small caps come up next, and then maybe crypto, if it does, which I don't think it does, comes up after that. So things progress in that natural order. People put their money in safe bets. It's a very logical thing to see. So of all the markets, Russell's the one that's not really, getting a lot of traction, while the S&P is moving up and the Nasdaq's moving up faster, right? And you're just seeing that normal mechanic in a recession. There's nothing to be alarmed there. So if you start to see the Russell moving, right, the other things would have already moved. So the last thing that's going to move is smaller caps. People are going to assume a lot of risk right now. The reason the stock market's popular is because the market's still a little bit of inflation. Fed's going to kind of go lax on their rate hikes, right? Maybe go down to rate cuts at some point. And so Wall Street will understand that the battle against inflation is going to kind of pause for a little bit, at least on the Fed side. Natural mechanics will take over, which are slower. So people are saying, well, I can either leave my money in my own bank account at 0.4% CPI. Remember, if you look at the CPI, it was a 0.4%. When you month over month extrapolate that, that's about 4 times 1248. So 4.8 to 5% year over year inflation. Fed targets 2, right? That's a bad metric. 0.4 is not great. 0.2 month over month is still good. That's in the realm of about 2% a year, which is the Fed's target. So inflation's still going to be there. Your cash loses money as time goes by. Your fixed income returns lose money as time passes into maturity of those fixed income investments. So people don't want their money sitting in cash. They don't want their money sitting in bonds. So they're taking the next best thing, stock market. They're battling. They're saying, you know what, we're in a recession. The stock market's not going to crash. I'm just going to plant my money there for a short period of time. And you're seeing natural buyers step in. Show that metric really quick. We always talk about this every single morning. Welcome to the stream, dropping these knowledge bombs every single day. We love you guys. You'll come here and learn as much as you want. Natural buyers stepping in, the asset managers on the commitment of traders TFF report for the S&P futures. This green line goes up. It means the asset managers, institutional traders, are becoming more net long. They're buying more and buying more and buying more, accumulating since October of last year. The hedge funds are continuing to short the net contrarian side of the market. Leveraged funds right down here, blue line. More shorting against this, which there's a recession, we all agree. Market makers still hanging on to a net positive, about 80,000 contracts. This dealer intermediary line. Markets never collapse or crash when that red line is greater than 0. In the history of this report means that when the banks are holding the bag, they don't collapse the market on themselves. They at least distribute that bag back to willing buyers, which is exactly what they're doing. They're keeping the market floating to attract buyers, and then when they're short, then the market then falls. There you go. So short squeeze still continues. I'm in the 44 to 4,600 camp over the next 2 months. And then next quarter earnings are going to be completely garbage, and the market's going to top out there and probably immediately stabilize and hold for a couple months and probably pull back. And then we have a longer recession. These mechanics are just getting started. These problems are just getting started. A lot of people aren't feeling the burn yet, in personal lives, because it's just getting started. So again, it's not a bull market. Oh yeah, this is the gap from the other day right here. It's not a bull market yet. Not gonna be a bull market for a while. I'm sorry, let me start over. It's not a bullish, or it's not a non-recession economy. It's clearly a bull market right now. By definition of a bull market, there are willing buyers and prices going up. My definition of a bull market. Short-term bull market, though. About one more quarter of this, and then the market's probably going to start questioning what it knows about itself. Quantitative tightening kicking, a lot of other things kicking. Okay, let's get ready to see if I want to go ahead and press myself for a long here. Resiliences are still negative, so risk and reward is here to draw out the trade. Like I said, I'm just waiting to see what happens. We get back above hedge pressure. IWM's now hedge break. Very careful there. So we are getting that first bounce. Here's how these things work, right? You're outside the redistribution zone. This is resistance, and that's resistance in case of res less than 0. Irrational, so you have to assume that these things are going to lag, and of course I need to be less than -10 to really have some confidence in this positive 10. So even if it does recover itself, it's going to have a hard time battling through there. The one thing to take note, the DD number, again, greater than 0.6. You have, again, competing mechanics. DD says this wants to approach there and try to at least get to there. Now it's going to be hard if we have a hedge pressure break, but if we have a hedge pressure recover, and over the course of the day, about lunchtime or so, resilience gets to be positive, this can push in the close, maybe do something like that. But this is your limit of the range for today. Pretty easy to see that. Now again, if we lose hedge pressure and continue to collapse down, there's a lower DD band. This is set up here. Again, it's not trade advice. These are just the plays that I see. I'm going to take my particular setups. You guys liking Rocket Scooter? Feel free to check out the extended trial. You can get the platform. Do this for any stock, any ETF, anything with options. We can do this type of analysis on. Super clean, super simple. No more technical indicators. No more multi-time frame confluence. Time to step out of the 1970s and get yourself a modern trading platform. There's that. Res less than 0. Then if we get the end of the day, res greater than 0. If we get that, and DD is still greater than 0.6. This is traditional setups here, right? Does everyone agree or disagree? Rock Scooter Vets, let me know. Do you like what I drew? See how when we had that class yesterday about trading when irrational, I always talk about different setups, right? 0, hedge pressure break. October is still bottom? Yeah, 100%. Not forever, but for this year, yeah. Probably for the entire year. It will probably take till the end of the year for us to press through October lows and go lower. There's just no mechanic. There's no mechanic at this point in time for the stock market to collapse. And the only thing that would change my thesis would be if some surprise happened, like a major blue chip company or a major bank files bankruptcy and causes a scare in the market. Market's very stable right now. They're a willing buyer since October, and people are just planning their money. They're going to sit there because they're all the mechanics are very predictable. Everything going on right now is predictable. The Fed's hand is predictable. Nothing is scaring the market. Everything effectively is priced in. Now, fundamentals are going to still decay into like a worsening state for the economy as the months go by, but they're not deteriorating very rapidly. It's gonna take some time for the recession to pick up momentum to where you're feeling the burn, right? As a person, consumer side, once you lose your job and you're unemployed for 3 to 6 months, that's when you start really, right, defaulting on loans and credit cards and things like that. And then that's when you start to add to the statistic of all the bad parts of, you know, bank earnings come down because you're not out there giving them money on interest with new credit card. You know, Walmart sales are down because you're not out there buying TVs. Whatever the case may be, it takes you a while after you lose your job to start affecting the economy. So that slowly starts to create problems. And so those metrics will just get worse and worse over time until, you know, companies start stabilizing and hiring people back and the economy starts growing again. That takes a long time. So in the meantime, the stock market is not going to collapse or crash on itself until A, market makers themselves accumulate a non-net positive position, which means this red line goes below 0. History of this report, I'm going to teach you guys this knowledge bomb. Love dropping these here. You know, we're the people who really invest our time into teaching things that are kind of a little non-standard, right? Everywhere you go that wants to teach you trading or show you trading, it's going to just put a chart on the screen. It's going to have 1,000 indicators on it. And indicators, emojis, lights and sounds, laser battles and bullshit, and they don't know. They can talk about the economy for 5 minutes to save their own lives. So at the end of the day, we're going to step out of the traditional, let's just look at the chart and see what it says. And we're going to come in here and really understand why the market's doing what it's doing. So in a non-conventional manner, this guy right here. See, I'm not taking any trades. Look at that. Nice and clean. Hedge pressure break. All those lights are red. Looking good, looking good. Okay. There's that lower DD band on the S&P really quick, and I'll show you something really cool. Look here. There is a rule that says if the DD is really long and strong, it doesn't want to touch this bottom green line. So not wanting to touch the bottom is a characteristic of DD. Okay, DD's strong enough, it will likely not want to touch the bottom. Keep that in mind. Now, if it does touch the bottom, then that will dictate unusual behavior, and that'll start scaring me. So there's 2 rules with DD. If DD is what we call quote unquote bullish, even when irrational, it tries to repel touching that lower band. That is a rule that we do have. There's a whole video series on it. It's DD. When DD is bullish, it wants to not touch the bottom. So that means if it does, even if it just touches it, it's scary. It's time to bail. You all understand that rule? Yeah, or Drew Shank reading what you're saying. How do you turn resilience chart on your screen? Used to be on there like yours, but not anymore. add it. Go back to indicators and just add it, and it'll pop up. How do I know so early that hedge pressure might be broken? No, I didn't. You can't guess. You don't know that hedge pressure is going to can be broken unless it's like there's a couple ways you can forecast a hedge pressure break. Like if hedge pressure is inside of the redistribution zone and resilience is positive or negative, the desire to fill the gap will overpower hedge pressure sometimes. But here I didn't know. I said it's likely probable, but there's no way that I can know or guess that 100%. I usually err to the side that it doesn't want to break. And when it does, it's just that smaller percent of a chance that I just get out of the way. So you can't guess the random part of the market. Nobody can. So if it gets overpowered by sellers, then it breaks. So the idea is it doesn't want to touch this band more often than not. We know that rule all the time. If it does press or even just touch the band for a hot second, it's a bad situation for the whole market. So I'd be very nervous here. We talk about this one a lot. So the idea is that you're going to see there's a lot of buying pressure here to keep the market from going unstable. If it gets overpowered, it gets overpowered and it collapses. DD's holding the fort, 75. So being above 0.6, we usually expect it to repel and not touch this lower green band. Y'all know that rule, right? Okay. So let's be cautious here. Like I said, no hedge pressure breaks, lights are red, no touching the ETF. Chilling on that. Everything else kind of looking iffy. Double check VIX really quick. Nothing to see there. Okay. Let's go ahead and I'm looking at MHP breakdown, the breakdown side. See if there's anything down here. Monthly hedge pressure break. Soxel's break, or SPXL is breaking monthly hedge pressure. Walmart. These are going to be monthly sentiment to monthly expiration. So we call it structure, or real institutional sentiment. Boy, S&P, hang in there, baby. The resilience is getting a little more negative, which means we're having half gap breakdowns. Search for some of those just to eyeball it. See which ones are actually breaking through half gap. Palantir. These are ones around the edge here. JLD, Walmart, Tesla. Ooh, Tesla. That's going to be a problem. Let's keep Tesla on the front end. My chart. Watch what's going on here in Tesla. I'm trying to get that price lower, huh? Hanging in there like a champ. Fingers crossed. Let's see if the DD roll kills it. All right, in the meantime, you guys want to see some sexy test server action? I know I do. You want to see new features coming up in Rocket Scooter. Being released tomorrow morning. Come on, S&P. You know you don't want to crash. It's not looking good. Not touching it, just waiting. Okay. Just doing a review of some things on the platform really quick. I'll show you guys the test server. Boy, S&P, you are not liking that DD band. Let's go. Hang in there. Tesla, hang in there, baby. You expect that float to come in pretty quick, and the fact that it's hovering is not a good sign. But again, when you're watching for this rule, if it does hit DD, it's a done deal. Now, resilience again, or DD is pulling down to 0.7. We have a whole video series on this one particular thing. You see how it's trying to float? This is a mechanic. We always talk about this. And DD number is currently 0.73. You guys know that? So it's going to try its hardest to fight against this. There's going to be a lot of volume here. Market maker is going to try not to let this lose structure. And if it does, then it's just game over. Like, again, if you break this, the market just capsizes and becomes very volatile. It'll be hard to predict anything from here further. Let's double check to make sure we don't have any kind of impact red lines as well while we're waiting here. I'll show you guys some test server stuff. So let's go ahead and work this out really quick. Welcome to Rocket Scooter, friends. If you're first time here, feel free to go down that description below. You can check out the extended trial. You won't be disappointed. You're going to learn so much in a very short period of time. Hold on one second, guys. There's that rescue candle. We always talk about that. All right, guys. All right. Tesla rescue candle looking like we're coming out of nowhere. Let's see if this holds. You see that? When I talk about the market just consolidates and then starts to move. Hopefully it hangs in there, right? I want this market to not start collapsing yet. I want the squeeze to continue higher or lower. Got the right teacher control. Oh, thank you. Now again, you see how there's that float here. It's gonna try to hold, and if it doesn't hold, that's a bad sign. It gets really choppy and really violent from here. So be very careful. There's the whole mechanism is actually called the DD float. So there's just wicks there. There's a magical force. The magical force buying. There's nothing magic here, and you see all that buying pressure to continue to absorb the market here to keep structure. If this falls here, what happens is volatility is going to get crazy. So if you just touch this, I don't care what happens. If you touch this with DD being positive, or sorry, DD being bullish, 0.72, right? Greater than 0.6, you guys remember the video is the number. Like that's our little rule of thumb. 72 is very bullish. Bullish DD doesn't want to touch the lower band first under most circumstances. And if it does, even if it touches it and goes, that's a bad sign. Just touching it is a bad sign. If it doesn't float, just tapping it's a bad sign. And typically that becomes this. It just gets crazy. So if it just grazes and walks up and equals that green line for a hot second, whatever it does, I would get out of the way if I was in any trade whatsoever, because it will start to get crazy. It is such a low probability that it touches it and then goes. It wants to not touch it and then go. If it touches it, it might look like it's going to go, and then it's completely random. If you touch the lower band with DD being bullish, your market is random from there. It'll be crazy. Heed my warning. Yeah. So stocks are holding that bull side. The market's going to try not to lose control in S&P futures on the bear side. So the float is there. Does everybody like that? The idea that a technique that we do teach called DD float is very present right here. It's something that happens every single time. The fight is barely floating above that level, right? It's fighting to not touch that level. There's a huge, if you touch this, volume is going to go out of control. Random volume spikes throughout the day. Very careful. These are volume prediction methods. It's this cool mechanic that goes on here. Oh, it's trying. Right? Hold your breath. Hold your breath. Isn't it cool that we have a technique that is automated that allows for us to understand this, right? And see this. Y'all like that? Smash that like button over here in the stream. You tired of chasing price around? Looking at shapes and colors and trading noise on a technical analysis chart? Ooh. Modern day, we have a line sitting there at 5 o'clock in the evening yesterday, where that level is present all night. How do you compute the DD band? But why? Okay, so there's a really neat mechanic of something that happens when it comes to the risk interval. The risk interval is one of our most important tools that we have. Futures margin requirements are what we're exploiting. If you didn't know that the margin requirement set for futures contracts is one of the most important numbers in the entire stock market, welcome to the rabbit hole. Proof is in the pudding. We can create rules like this that are consistent, right? It comes down to all that math and magic that we put into understanding how the market structure works. Structure is things that are mechanical. If you want an example of what a mechanical limit is, anytime the S&P drops 7% during US market hours, right? The S&P stops trading, right? The futures do, the circuit breaker, right? And it's something that applies to everybody. And that's not the mechanic that the risk interval is exploiting, but it's an understandable principle because you've all experienced it. You haven't experienced what I'm showing you here, because this is what's going on with market makers. These are futures market makers. They're the ones behaving right here. But what happens on the, say, the limit down, for instance, where you go 7% and the stock market ceases trading, well, actually it doesn't cease trading, it ceases selling. You can always buy to the ask when the circuit breaker is triggered. You just can't sell to the bid. You're stuck if you're okay, let's go. You're not allowed to continue selling. So the idea is that rule applies to everybody. It's consistent, right? Nobody can escape that rule. Well, what we're exploiting here with the risk interval is also something that applies to everybody on the dealer side. Market makers must behave here. Similar concept. Now, to explain what it is we exploit would be giving away a lot of information to competitors. And as I know, wannabe competitors watch my stream every day, hoping to learn something so they can boost their sales. It's hard to watch a rocket go by and go viral without being a little jelly and wondering how all this works. But we do talk about it in our course section about what it is we're working on. We're exploiting a process that CME Group uses to set margin requirements. Those numbers are not arbitrary. Those numbers are very, very meticulously calculated, very sophisticated number that is based on the risk and exposure of those with big positions in this thing. Who has big positions? Big reportable positions in futures? Well, these guys. dealers, asset managers, leveraged funds, right? Those are the folks that are held. Oh, sorry, my bad. Let me go here. These guys. All of your big institutional positions. Markets move because they have to, not because they want to. Yeah, they have to. You're always finding buyers and sellers. So what's going on at the bottom of a DD band? We'll talk about that a little tiny bit. There is just a very large risk to everybody. When the contracts lose this much value, exactly that much value, it triggers something for everybody. As a matter of fact, it's off of this price right here. It's one risk interval below the close price. The day before, when the market last trade on the Globex where it halts for an hour or shuts down for an hour, exactly one risk interval down. Then the risk interval is a separate calculation. A DD band is a span over one risk interval up or down. It produces a support effect. Now that's bad. Okay, market's now going to start. Oh wait, no, it's almost there. Almost there. Almost there. The idea that you see it having a hard time breaking this is proof that we know what we're doing. So far, so good. Does everybody understand that before I go into the detail? The idea that for the last 20 minutes, it's trying not to touch a level. Do you all believe me, at least so far? Everyone, yes in chat. Throw some rockets in chat when I'm about to teach you what's going on here. Doesn't mean it can't break, but do y'all understand that there's something that we know? And this is it's an automated level. We automatically calculate this. Okay. The idea that I can sit here and tell you this is going to happen, well, before it's happening, means that we know something that's happening here. Let's just give you a surface level explanation. If you just touch that line, imagine everybody out there. Here's an easy way to understand. It's not exactly what's going on, but easy way to understand it. Imagine you and 9 of your friends have been elected by let's talk about like a Marvel movie. Y'all are all superheroes. You've been elected by the gods of the universe to hold the world on your shoulders, and you're all standing there holding the world on your shoulders. And the minute price touches that green band, one of you is going to buckle, which is going to cause everyone to fall. So all of you together understand this principle, and you do everything you can to fight it off together to prevent abnormal risk to one, which is abnormal risk to all. And the way that works is through hedging. This is one of the most largely hedged areas of the market every day, which means if you break through that, not only do you punch one of the Avengers and knock him over, the other 9 will topple with it, and then the market just goes crazy. You lose the people keeping the structure. And that's the way to explain it in a way that you might understand. Because I just saw Guardians 3 last night, so I'm still thinking about Marvel. But the idea is that there is a large buffer of hedging here. And anybody on the dealer side, or anyone on the exposed side, especially liquidity providers, have all the vested interests in the world to not let that happen. And somebody said earlier, markets only move because they have to. If it happens, it just means we have overpowered and are selling the desire of the market to hold a structure, to hold things together. So it means the selling pressure is absolutely abnormal. And those designed to keep the market intact, i.e. providing liquidity, are now at risk themselves. And the best way to think about it. And if one person starts selling because they're at risk, then it topples everyone else that's holding up the world as well. Do we understand that a metaphor? I guess it's a way to say it. All the banks would love it to stay there. They love to supply structure. Why? Well, right now, DD is showing that stocks themselves are bullish. Okay? Still in the bull territory. DD nice and strong. Stocks like Tesla are running. Stocks are moving up. Why would the S&P sell so hard if stocks themselves are still bullish? So they don't, it's like an autopilot that doesn't allow the S&P to deviate too far from what its ultimate destiny is, to track the stocks, or track the underlying, which tracks the stocks within the index, right? The best way to explain it is that everybody's hedged very heavily at that level, because everybody knows everyone else, including themselves, have a lot of risk below that level. And the reason that the distance of one risk interval from the close price is important is part of the proprietary part of how DD works. We don't talk about why it overnight. Why do they care overnight? And the best explanation for that is, imagine that the S&P tracks the sum of the stocks. Imagine that, right? That's supposed to do that. That's what it's designed to do. And the S&P futures are a tradable instrument that can trade all night long when the stock market's closed. So clearly, it's only trading overnight because it's reacting to global events in other markets. Ideally, the U.S. markets open last and close last in the global chain of markets. You have Australia and New Zealand, they open first, then Japan, then China, then Germany, then London, and then New York. We're at the end of the day, end of everyone's day. We're at the end of the trading day. Everyone else has their trading day before us. Our trading day starts at the end and closes at the end. We're the last to open, last to close on the global planetary day. So everyone else in the world is their markets are moving. And since we're last, our futures, oh, there's that DD float. There we go. So there, now let's, again, we're not in the clear yet, but thank you, Tesla. Loving you. So the price dropped because retailers think we're going down. No, price is dropping because people are getting squeezed out of S&P products, but not getting squeezed out of the stocks. The stocks are still holding the fort. So imagine you're a big hedge fund, right? And you're only long SPY. And imagine another hedge fund across the board is long a variety of stocks. And hedge fund A is in a margin call. Well, hedge fund A needs to dump something. Well, they can only dump SPY. They don't hold any stocks to dump. So they're going to be selling SPY while the other firms are holding the fort. So the stocks will stay put. Everyone's staying put. But the SPY is slowly going away from some of the stocks it's tracking because one fund is getting squeezed on SPY. Follow it so far, Chris? But SPY itself is being priced by market makers to roughly equal to a certain mechanic that tracks the SPX, right? So when that selling pressure is over, there's an opportunity of arbitrage where if the SPY trades lower when the stocks aren't moving, then one of two things have to happen. Either the stocks need to come down to match the SPY, or the SPY needs to move up to match the stocks, or they're both going to move towards each other. That opportunity, that gap closes in. It's called arbitrage, right? That trade opportunity is there. So effectively, that will be something that happens. Now, you don't know which one's going to happen, but you wouldn't short the SPY or long the stocks in that event. They're going to push towards each other. So any trader worth anything would short the stock and long the SPY and take that bet that they'll run into each other every time. Does that make sense? Everyone, yes, in chat if you understand that. Let me draw it for you. Firm A has SPY. Y'all get it, right? It's a pretty... Yeah. A is selling SPY. B has stocks, right? Stocks. And stocks are flat. So SPY needs to track the stocks, which means they're going to be in tandem again. They're going to be strapped to each other again. So if SPY is going down and stocks are flat, they got to meet up again at some point, right? So you wouldn't go in there and long the stocks like an idiot or short the SPY like an idiot to expect them to diverge further. Because the reason they're diverging is somebody is getting squeezed. Either the owner of the SPY is getting squeezed. Let's do the example of maybe this is also going up. Stocks are going up and SPY is going down. There's telling you one of two things is happening. Hedge fund B holding stocks is getting squeezed on a short. Hedge fund A holding SPY is getting squeezed on a long. One of them is getting forced out of a trade. If you go to continue to long the stocks or short the stocks, you're really trading against one firm that's getting squeezed, and that squeeze doesn't just last forever. That's a dumb trade to make. Most people would go in there and long the SPY and simultaneously short. And again, you wouldn't go short all 500 stocks, but the idea is that, you know, in a theoretical sense, you would trade for them to move towards each other. No matter what they're doing, they're going to catch up, and this is a winning trade. As this gap fills, it doesn't matter if the stocks come down or the SPY goes up or they meet in the middle or they both start to rally or both start to sell. If you trade short the stock and long the SPY, you will make money every single time when they diverge. Every single time, because they ultimately connect if you do that trade correctly. At best, you wash. If they run both to the middle, then you make as much as you lost and you ultimately wash. So you're only going to trade one side or the other, right? So the idea is that people will trade that actually happens. So they might sell calls above and sell puts below to bet that neither of those things happen and they just meet somewhere in the middle, and then all of a sudden they make money on both sides. It's a very appropriate strategy for closing the gap of things that deviate like that. Okay, now understand this. If overnight futures markets are moving, but our stock market, let's say like this is the previous day, our stock market ends there and our futures market ends there. And overnight the futures are trading, but the stock market is closed. You can assume there's invisible arbitrage. The futures market's going down because other markets are going down, right? There's no reason for our futures market to find sentiment changes overnight. It's just mechanically trying to match what's going on. If Asian markets start collapsing, well, our market's going to say, ooh, when it comes down to US hours, you might be collapsing too, because of, say, I don't know, Goldman Sachs is dumping all their stuff in Asia, and then, oh, they're dumping all their stuff in Europe. Well, shit, they'll probably be dumping their stuff in the United States. Let's start pricing ours down lower too. It's to get ahead of a possibility of our market opening with the sell imbalance, right? If you can detect that people are selling in foreign markets, well, our futures are going to price that ahead of time. It's futures. But it can't go too far off the path. You start to cause problems. See, those margin requirements are set based on expected volatility and ranges and risk and all kinds of things. How much money you must put into the bucket to own a position in a futures contract. There's only a finite amount of money, right? You price that. Ooh, and there we go. Okay, now's the problem. Oh God, there it is. It does not want. If it touches, it becomes volatile. So this is not necessarily that good. Yeah, we touched it. All right, market's gonna spiral. Be bad. Bad news bears. Just touching it is bad. Even if it rallies, it's not that. It's bad news. Yep, we did touch. Now it touched. It can do. It's now the market's now random from here. It's gonna do something random from here. You see how it spends a lot of time trying to fight not to touch. You want it to float away really quick, like it tried to do, and then the market found selling pressure still. Now everybody's awake. This is gonna you're gonna have random volume spikes. The volatility is about to pick up. Watch this. Oh, look at that. And as I said it, this is exactly from the lessons. Volatility is about to pick up. VIX is about to break into highs. Isn't that cool? Again, textbook stuff. Now, again, how do you trade this if we don't? I'm not going to touch this, right? We don't have a rule in what you do here. The market is statistically random from here. Your best guess is as good as mine. Days like this can close at highs. Days like this can collapse the market. Volatility is about to go out of control. So be very careful today in the positions that you're in. You all got it? Be very careful. This is a bad, bad, bad situation. Yeah, it's a risk market's risk engines. It's basically like that. If the contract loses so much value when the actual stock market is open, that arbitrage power that draws both to themselves, what if the futures market travels so far that the market makers that market make this are in a margin call. And when the stock market opens, they got to dump the stocks to go with it. Imagine you're a market maker, right? And you have futures. You have stocks. And overnight, the futures market trades down so low that you're stretched. You're having a problem. So you need to go out there and either rapidly buy puts, which is going to force put sellers to short the market to accumulate a surprise position, or you will just liquidate your stocks, which again will continue to press the entire market lower as well. So in the event that the two are diverging, if you start doing that, it will start to create margin calls in stocks, which will start to collapse the top of the market. So the problem is if you move so far and these contracts lose so much value, a certain amount, that everybody is at risk of market collapse overnight. So overnight, or even after the session, the equity session starts, the market will do everything it can. Everybody collectively will be fighting exactly this level. And the idea that you touch it, this is not to be believed. This, to me, it is 100% random from here. DD is bullish and you touch the lower band. Do we all understand? It is 100% random. This can end up at highs. This can end up crashing. From here, this is not a long to buy on. In my opinion, this is a random thing. We have so many videos covering this DD band rule. But the thing is that the idea that you have what's called the float, we see this all the time. It's exactly 31 points now, and that number does change. We have a bot in Discord that tracks that number, or sorry, provides that number to you guys as margin requirements changed. If margin requirements are set based on risk of people blowing up holding them, then think about it. The expected range of futures or expected range of a stock is set by the expected range of options. It's exactly how monthly maps works. Right, if you go into monthly maps, it's a similar process. If you know what a monthly map does, the space between here is the expected weekly volatility. This is the coolest thing we've made. Do you see how Tesla has only like moved that amount pretty much throughout the week? And next week, Tesla's going to be more volatile and much more volatile as the weeks go by. The idea that people's options will forecast volatility in the future. Volatility is how much the market can move to find buyers and sellers. And if the market moves to a place where you're in a margin call, that can create a problem that can collapse the market. So margin requirements are set based on volatility. Volatility is set on people's positions. People tell you what the volatility is, and they turn around and match the margin requirement to reflect your positional risk. So those margin requirements are a testament to how far the market net sum of all positions are being hedged at. Because people are telling you, these are where my calls and my puts are. I'm hedged here. You just announce to the market where you're having risk. If I buy 10,000 puts somewhere, I've announced to the market that I have risk there. I'm short there. For whatever reason, I'm exiting along or I need to jump in a short. So if everybody's announcing their risk through options and you know where that expected volatility is, which we prove with the monthly map, it's the same thing in futures. What happens is if you are trading in this expected volatility, because everybody's puts are there and everybody's calls are there, and all of a sudden the market presses through an unexpected, if everybody's positioned here and here and somehow selling pressure happens there, the put sellers are going to be forced to short, markets are going to collapse. So the put sellers are going to do everything they can to long the market to keep that from happening, or else they're in bad, right? It's a similar process. You announce where your positions are and where your risk is. Collectively, everyone knows where everyone's risk is. And you've sold options, you have obligation to be short below that line. You're going to fight it off, you and everyone else, so that the autopilot, essentially, if it's the autopilot mechanism that tracks the S&P that we're exploiting. The very thing. You can't go too far off course or the rubber band that's connecting the two will snap. Do we understand how that works? It's like this, right? It's two things moving, and they're connected by a rubber band. If it stretches too far, the rubber band will snap. And what happens is volatility just goes out of control and the market loses control. Liquidity dries up, and basically the mechanism is everybody, you know, when volatility is there, liquidity is low. Liquidity is fewer buyers and sellers mean less money for the system, less fees being paid, less trades happening. They want to keep things in order. Order is money. Basically it. We understood the CME group sets margin requirements based on the risk of the positions of those funds that are market making. Well, then there you go. The reportable positions, all of them, are considered in CME span. So if you're short here, you're long there, someone else is short there, someone else is long there. They literally paint the picture of where their risk is, and the CME goes, oh, okay, so here's the margin requirement. We're going to set it here based on everybody's expected position. So essentially, market makers quote the bid and quote the ask. They hold options, they sell options. All those things provides a structure of the market where they want to long, where they want to short, what they're willing to hold, how much risk they have in case they start getting squeezed. If puts go in the money, people are forced to short and snap that rubber band. All kinds of structure takes place in that one single magical number, the maintenance requirement. And so the fact that we can create a rule that's repeatable is all you need to know. What exactly goes on there, I don't explain fully to maintain the proprietary aspect of how that equation works. Obviously, there will be an immediate flood of copycats because the rule is repeatable. We don't want prying ears to go spruce up their magical, colorful shape spirograph system with an actual thing that works. So we gotta keep it. Mum's the word. Just got from a meeting. Looks like MHP break on IWM. Ouch. We gotta be very careful here. Remember, we touched lower DD band. That's highly irrational for the market. I'd be very careful there, you guys. Highly random for the market. So SPY. Let's look at monthly maps really quick. Let's go through some test server stuff, you guys. Ready for this? Show you something really quick. It leans to, you would say that it leans to not wanting the lower band to be touched first. The more appropriate way to say it is the market doesn't want to stretch too far away from its ultimate destiny, right? The stocks and the index need to meet together. So we kind of redefined it to say, while it does, we do think about it, it wants to go to the upper band first. The more appropriate answer is that it doesn't want to go to the lower band first. It doesn't mean it wants to go to the upper band. That we kind of redefined it as the understanding of the float got a little better. So the idea that it is going close to the lower band or touching the lower band is what violates the rule. And a very small percent of the time that rule is violated. It's very rare this happens. Like I said, don't believe this, right? The market's going to be volatile and shit's going to happen. The minute you touch the band, there's that volume I talked about. The fact that you start... wait, that's not where the band is. Band is right there. The minute you touch the band, the market's going to go ape shit. That volume is massive. You see that? Just like we said, this is predictable. No. It's you guys. When I went through an entire lesson yesterday. When these lights are red, how to trade. Do you see me making a trade right now? Do you see me touching this fucking thing? How to trade this? Close your platform down and go watch the entire first week module on risk management. You know it, baby. You know it. You know it. You know what I'm trying. I love you, man. You know it. Go. Why? Tomorrow's another day. I'm up 550 something % for the year. No. Risk nothing. Tomorrow's another trading day. This is amateur hour if you're touching it here. Amateur hour. You're coin flipping with your hard-earned money. I'd rather buy a lotto ticket if that's the case. Nothing. Mow the grass, baby. Now, you do whatever you want with your trading. Again, this isn't trading advice for you, but how do you trade a BRS? You don't. When markets are irrational, certain irrational rules are no trade, no matter what. Okay? In general, for me, my rule. All irrational rules mean don't trade. If you take discretion, 10 to 20% of your risk. When markets are irrational, pivots can overshoot. So if you do use anything, you have to assume your pivot's going to overshoot. And how much? You have no idea on how to gauge that. Random is random. That's it. I don't use liquidity map other than I know that pivots will overshoot. I don't try to take those sharp scalp trades. Period. I need markets to stabilize before I want to make a trade. If I'm using anything now, it's DD and resilience. That's it. And they're both giving really solid signals. One of them is really strong to the bull side. One of them is really strong to the bear side. Isn't that crazy? So you're seeing discrepancy where the stocks are bullish and the S&P is bearish. And isn't that exactly what we spent the last 30 minutes talking about? The S&P is deviating from the bullish stocks. So they're going to slam together in the middle, and it's your guess as good as mine. If firm A is going to get squeezed on their SPY or firm B is going to get squeezed on their stocks, go ahead and guess what those humans are going to do and how their risk is. And you tell me how you're betting. And then you sound, oh, he's right. That sounds silly. I want to just wait this one out. That's how it works. Does it all make sense now that you see that? Why is resilience negative and DD's positive? I spent 30 minutes explaining how that exactly happens. Those DD bands don't want to touch because that rubber band's going to snap if it does. And there's this volatility that we just talked about. Volatility is how high and how low the price needs to go. If there's a consistent time between buyers and sellers, I mean, you hold time constant, those partial differential equations. Volatility is how much, if the peaks are equal distant in time apart, volatility is how high and how low you need to go to find buyers and sellers, holding the mean sale price constant at a fixed time between peaks, okay? That's the easiest way to explain volatility, i.e. they get wider, volatility up, they get lower, volatility down. And there's that widening when I say if you just touch that band, that volatility is getting wider. And the minute I said it, look how that's diverging. That rubber band has snapped. Now the market's going to be frantically chasing, the stocks are going to be selling, the market's going to be up, and everything's now frantically chasing each other. While that arbitrage trade is getting squeezed. Like both sides are now in a weird spot. So the idea that S&P resilience shows SPY gap downs trading down, DD is saying, well, stocks are still getting bullish hedging that's pushing them up. They got to meet in the middle. And the fact that the market touched that structure point caused abnormal hedging, what we talked about all morning. Look at those volume spikes, right? Just the touching volume spike. How massive that was. Look at these large volume spikes that are higher than the opening volume just to float it. Volume doesn't normally do that. Volume normally decays over the course of the morning. Volume doesn't stay elevated or get worse unless something's happening. So you guys had a great lesson today on actual market mechanics. If you start touching this, while that's positive, that rubber band has snapped. It's a free-for-all frenzy at that point. Right? So now everybody's like, okay, we're going to start piling in. We got to do something. I got to do something. Somebody said that right. I got to do something. Something happened right here. Right? So you're going to see volatility increase, okay, abnormally. How do we know that? Well, you should see the VIX going up. The minute that band touches right here, the minute you touch, you're even getting close to it. From about maybe 10 minutes after 10, you're going to see volatility go up. Right? Isn't it cool that like you're essentially scripting out certain mechanical parts of the market? Did I check UVXY for pivot? Yeah, I do. Oh. What the hell's going on here? My browser crashed. Try that again. So right now, you do have one saving grace, is that the VIX does have a lot of hedging keeping it control. So the volatility is increasing. You need to watch if VIX starts breaking monthly hedge pressure break and hedge pressure break at the same time, the market can collapse today. So be very careful. There's one saving grace, is that volatility stays contained, so that market doesn't spiral out of control further. That rubber band is now snapped, right? So volatility can increase, and as it increases, it's going to bump into a resistance. The one saving grace today is this little line right here. This market mechanics, these aren't, I don't do lessons in these Zoom call, on these YouTube streams. All the magic, all the lessons are taught in the program. We don't teach for free in here. I just explain my rationale for the trades I'm doing. No, I don't go post. I'm too busy to go post things. There's a curriculum in the Discord. Just go watch all those videos. It's all there. I'm not a influencer. I'm not a content maker. I'm a trader, man. I'm building a trading platform. I ain't got time to go make content, post videos, and make reels and all that bullshit. It's live. You can click the rewind button if you want to hear it again. Sorry. But yeah, with the curriculum, man, you'll love it. Ralph, you're in the program, dude. You know it. Come on, you've seen all this stuff before. But I like explaining things that are happening while it's live. It's always a good lesson to explain it while it's going live. So the idea that you just touched that band, the market's going to be pretty crazy. So you can see that volatility itself, the VVIX is going to be going up. Last lesson. So the volatility of the VIX itself is going to get worse from that moment in time as well, which means the VIX itself becomes more volatile. The mechanic, again, that volatility is the state at which, holding everything else fixed, that the market gets wider and wider from about, when I say about 10 after, which is about like right here. That VIX, while it was kind of tightening and volatility was elevated, the volatility of the VIX is getting wider. Do y'all see that? The VVIX is going up. So anytime you touch a lower DD band, the VVIX goes up, the first derivative of the VIX itself. So the VIX becomes more volatile, which means the VIX becomes out of control. The VIX is set by supply and demand of options, and there's a whole equation for that, which means people are just running in and throwing in last minute emergency options near the money. causing that VIX and that illiquid market near the money or in the money where the option even more illiquid causes the VIX to go out of control. People are like, oh shit, this wasn't supposed to happen. I need some puts right now just in case. And then that VVIX goes up. It's all part of the same mechanic we exploit. Pretty cool, right? So all the predictable things we say that happens when the DD rule breaks, the band rule breaks, is very, very repeatable. Number one is you'll see abnormal volume spikes just the minute you touch it. The moment it touches, something triggers. Our rubber band has been snapped. You're now going to see asymmetric volume distribution. It's going to be all over the place. You might see in a minute a huge volume spike here. See a volume spike here. The market can go up here, collapse really quick, squeeze really quick. It's going to be all over the place. Stocks are up here. Futures are down here. They got to collapse into each other at some point. The market knows that, so volatility is elevated, number one. And the minute that hedging starts taking place, people are jumping into random positions to hedge, which causes the volatility itself to become volatile. So the VIX goes up. All that is part of that lesson of market structure 101. So the minute you just, doesn't matter what happens from here, the minute you touch this, market is 100% random, and volatile. Not only is it volatile, but actually, it's not D. Del. Change of volatility over time at a fixed price in the underlying. It's greater than 0. It's a partial differential equation. Says you hold fixed price fixed. A change of volatility over time is likely to be greater than 0, which means your VIX is accelerating. Which means your VIX shape itself can start to accelerate and have an inflection point because the derivative is greater than 0. So you're going to start accelerating your VIX, which means that it can start curving very rapidly. So be careful. All right. It's easy to teach how to curb your fear with mechanical risk management, though. Teaching you how to rein in your greed when you see opportunities is something else entirely. Been very valuable. Oh, thanks, man. Glad you like that. The idea right now is, okay, what is there an opportunity? Am I missing out on something? You're not missing out on anything by being empowered and choosing to avoid something that is out of your control. But the neat part about it is that from the moment it gets close, I'm teaching this lesson on what happens, right? You can't trust anything from here on out. The minute you touch this, you can no longer trust it. Look at this. Nice little clean rally. Nice quick selling. Remember I told you those candles become very rapid. People are getting squeezed and positions are shifting very rapidly. So is this pretty cool? Like there are mechanical sides to the market. All Rocket Scooter is designed to do is exploit the mechanical side. Do not ever be fooled by someone who draws technical indicators on a chart and call it structure or anything else. Anything that looks at price candles is completely stupid to the structure of the market. This is an exploit of something called SPAN, S-P-A-N, program that the CME group created to gauge risk in the futures market, to set margin requirements, to set minimum performance bond requirements for clearing firms, to match the risk of market collapse based on the people holding the positions. When I say, imagine all of you are the Avengers holding the world up, you're the people holding the inventory, market making this stuff. That's the metaphor, right? You have the world on your shoulders. This means you hold the inventory of this thing. If the rubber band snaps and the futures and stocks all spiral out of control, continue to crash, and you bankrupt your market makers. Imagine this. Imagine you being a casino and all of a sudden the chips in the dealer's pockets have no value anymore. You take all the chips away from them. They no longer can host the game at the table. If you yourself have no value, you can't bankrupt your market makers. You can't you can't, like, if 10 of you are holding the world on your shoulders, you can't start pouring oil on the floor and making it slippery for you to do your job, right? You don't want these things to happen. So think just in a way of thinking like that. The margin requirements are set so meticulously to prevent the floor from getting slippery underneath the feet of the people keeping it floating. And that's the best way to say it. The futures have risk and they can deviate too far overnight if global markets are collapsing. Futures are at very big risk, causing a rubber band snap at the open if stocks also gap down into this frenzy VVIX explosion. So when the volatility, and I can tell you how the volatility itself is changing. You see how the VIX is getting even wider, even as it's collapsing? Does everybody see this? I don't know if you don't want it. I don't know if this is worth $35 to you, but I'm literally scripting out today's move exactly as it's happening, right? Is this a rally? No, it's none of this, right? Go sign up for the extended trial and watch all these videos, you guys. So for today, we just watch. I love you, Trusted D. You know I do. I don't give a shit what you do. That's your choice. You're asking what I do. Well, clearly you can see I'm just watching, right? I'm not the custodian of you guys' money and trades. As a matter of fact, this is trading. Every man and woman for himself, ladies and gentlemen. May the best man win. However, I'm sitting out. Y'all want to go out there and fight each other in this shit market? Have fun. But I'm on the sidelines until something stabilizes, something gets better. I'm surely not going to take any risk in this increasing volatility. But y'all see how that works, right? The minute you start touching that lower band, boy, oh boy, does it get crazy. That volatility gets bigger and it starts to, the VIX itself starts to get wider, which means VVIX is going up. So when VVIX is going up, then your price, like instead of it being a channel, like a nice clean channel like this, oops. Right? What happens is that you're going to start seeing curvature. If I were to draw straight lines, you're going to see curvature. Let me show you what that means. VVIX is going up. If I were to just kind of like draw a tiny little channel on these peaks right here, right? You're going to see curvature. There's your curvature. It's expanding beyond it, right? That's expected. So as you see those peaks get exponentially higher or exponentially lower, you will start to see that curvature. You can easily start seeing curvature right here. Because the VIX is getting wider, which means the peaks are getting wider at a parabolic rate. What's up? Or exponential rate. You hear the depth? Well, I didn't hear the depth. This discussion, this video is very helpful live. Oh, yeah, cool. Such an awesome BRSU short with res negative. And Karan nailed it, yeah. Best part of the curriculum is teaching you how to curb your greed trades. And in a bear market, when these lights are red, looks like IWM and QQQ have saved themselves so far. That's actually pretty promising. But the easiest way to see it is DD is really bullish and by its resilience itself is very bearish. It explains that exact phenomenon. The futures sold off a little heavier than the stocks are willing to allow. And since the market cap weight of the stocks is what the S&P is trying to track anyways, you can see right here. Let me go right all the way to here. I bet you there's a few sectors floating this market. Maybe tech, maybe a couple other things. Comm, there you go. Comm services. Look at, that's hella green, right? When in comm services was that Apple and Google, or sorry, Google and Meta? Yeah, not Apple. You got one good sector. And you have actually, the interesting thing is that I guess maybe the PPI, because you would expect consumers to be very affected by a not so bad PPI. So it's not getting worse. So inflation's somewhat coming down. You're going to see a little more interest in consumer staples and discretionary. So the core PPI came down, which would basically, when you think about the difference between core PPI and regular PPI, core doesn't include energy or food, right? And food, is very present in staples, right? So clearly, staples should be doing well on the spending side for the consumer, and then discretionary would be PPI in general, like all the things together, right? And so essentially, consumer discretionary doing great, right? This is a pure reflection of the PPI. Everything else is just shit in the bed. But there's enough market cap keeping things floating, at least for now. Oops, my bad. I'm on the wrong screen. There you go. Consumer services, communication services, Google, Meta, doing great. Discretionary and staples doing a lot better. Easy to see that, right? Yesterday, we had a clear break of SPY hedge pressure for 13.5. Was that a clear short win till... as I teach, I don't take hedge pressure break shorts. A lot of people here do, like Karan and others, like Karan scroll up. Everyone here trades a different way. The reason I don't take shorts is because I personally have a mostly long only strategy unless you are below monthly hedge pressure already. And then I take shorts when there's bear structure. I take longs when there's bull structure. If I don't get the short that I want when it's bear, I sit out. If I don't get the long that I want when it's bull, I sit out. Can't argue with bull structure. 2 days after the market bottom in October, I said, this is the bottom. I tweeted it, and it's been the bottom. I was right. The only time I said that all year. Nailed that bottom, and it's been bull structure ever since. Everything showed that. We're cool on that. And so now I'm either looking for longs or sitting out, looking for longs or sitting out. And that's a smart way to trade. I mean, there's no better way to do it, in my opinion. So if the market collapses on hedge pressure, I'm there with you guys. Some people like to take that short and love the excitement, thrill of the trade. I learned that if I don't take every single trade, I continue to practice my zenful avoidance of markets that I don't like. So I can continue to be confident that I can sit out with style, and I can sit there and watch all y'all make money if you're shorting and cheer you on from the sidelines. Because my strategy, I repeat the rules day in and day out to maintain my consistency with them. So it doesn't mean it's not an amazing trade. Karan and others here, shoot from the hip Mavericks love to take those really good trades because they have perfect control in those environments. I watch them trade a lot. I watch his stuff a lot. Literally does exactly what I would do if I wanted to do it. I look at it and I go, man, that's perfect. A perfect execution on that. But I don't, when markets are irrational, I train myself to sit out or trade very, very, very small. So the only shorts I ever take personally, doesn't mean that that's right. Okay. Remember, my style is my style. I've got kids. I've got a trading platform I'm programming. On Monday, I was interviewed 4 times on Monday. Interviewed 4 times by 4 different media companies. I was literally booked all day Monday because I was gone all week. Tuesday, I spoke on an international symposium. I'm always booked doing something. People are getting me to speak on this or talk on that, interview on that. I don't have any time to chase every trade. So I know my style is because of my lifestyle, right? And so if I only traded and did nothing else, I would probably be more prone to taking many more trades. So every person's desire or choice making is related directly to your own ability to have time to do it. The trades I do short, only get a non-neon green color. I always take the shorts against monthly hedge pressure from the bottom. These are my favorites to short. I take those legs. I don't take any of the other. I don't do any of the other red legs. Others might. And the reason why I don't is because number one is if you do break and become irrational, well, already I'm trading 10 to 20% of my position. And anytime you break hedge pressure to the downside, volatility tends to go up, which means the opposite of a rally. A rally, pretend that I'm drawing like a day's candle chart right now, right? And volatility tends to like tighten up in a good rally. The peaks and valleys get thinner. But when the market's collapsing on a hedge pressure break, then what happens is it becomes more volatile as it falls. So the peaks and valleys get wider, as we showed like just a second ago on that S&P futures chart. So already I'm playing small. Already the market's going to bounce around all over the place. It's going to take longer for me to get to my destination, so it's more time and it's more drawdown. I hate drawdown. My run up to drawdown ratio in my challenge account is literally 4 to 1. I'm not going to lie. That's phenomenal. And I don't like normally toot my own horn. 4 to 1 run up to drawdown ratio in a recession, in a bear market. That control of 4 to 1 is because I don't chase hedge pressure shorts. If you trade in volatility, your drawdown gets bigger as it falls if you get in at the wrong spot. Do you understand that? Which is why in accounts that punish you for a high drawdown, fixed drawdown, I have a rule for funded trader programs. I never short. Not one time will you ever see me short. I don't care what market you're in. Because selling markets increase volatility. Increased volatility means you're punished more for your stupid mistakes. By chasing the short, you're punished wrong. And if you're chasing the long while volatility is drying up, you're punished less. If I chase the green, I take a little bit of drawdown as it keeps going. If I chase the red, my drawdown gets worse and worse and worse as volatility goes up. So shorting punishes you more for inefficiency than longing does. It's a mathematical fact. So if drawdown is the thing that squeezes you out of a fixed drawdown account, why take the short side ever when you already have a guaranteed battle of trading drawdown? If it looks like a short day, sit out. Isn't that crazy, right? Y'all like that? I'm going to tell you something. If you want a trig, this is paper trading in a funded account situation. So I give you all the advice in the world. If you're trying to pass an eval account, literally do not push the short button ever. If you want one solid rule that'll help you with control, it's long or sit out. Not long one day, short one day, long one day, short. Pick one side and get mastery of one side. Master non-volatile long trades. If the market's volatile, sit out. Who cares? I've been sitting out day after day after day after day, and that volatility's pushing. Okay, I'm gonna get the trade I want. I'm gonna win. That's why stare in the face of increasing drawdown when drawdown is the thing that ends the game. Avoid drawdown, trade in environments where volatility is lowering, which typically is in a long rally type environment. And if you count every daily candle in this recession, from the peak in 2021 December until the bottom of October, there are more daily green candles in the market sell-off than there are daily red candles. We do a video called Candle Count. Every recession is like this. Every long period of drawing down, there are still more green days and red days. Is the biggest mic drop moment. I love teaching that class. So when you count those candles and you go, wait a minute, we're in a recession. There was like 52 or 53% green days, something like that, and like 47% red days while the market's selling, which basically means for every down day, there's an up day. Isn't that crazy? So it's a newbie mistake to believe that bear market means you need to be short-minded. The bear market doesn't tell me to short every day. The bear market tells you, well, I can only long every other day. I'm only going to play non-volatile markets in a bear market. Why? Because I've been trading for long enough to know what happens when volatility goes against you. It is the worst thing. Volatility spiraling out of control. You don't want to deal. Did you learn something today? It's just basic math. If there's a green day for every red day in a bear market. Now, in a bull market, it's 50-50 or 60-40. It's somewhere in between the two. You'll see sometimes 3 green days for every 2 red days over periods of weeks and months. And in bear markets, you look at the entire bear market, there's a green day for every red day and slightly more green days than there were red. And then people are like, well, I didn't even think of that. So in reality, it doesn't mean you have to chase every short. Markets falling is a very, very rare thing. Even in a bear market, markets might have fallen for 2 or 3 days and then they relax for 3 months. Okay. And that's what you normally see. I've been trading for 13 years now. I've seen multiple bear markets and 2 market crashes in my life. Or 3 market crashes if you consider COVID. And James John says, in the last 127 days, there have been 67 green days and 61 red days. Isn't that crazy? If you guys all just learned something there, thanks, James John, for that there. Isn't that crazy, right? Doesn't mean that you have to jump in and try to short every single day. Days that collapse to hedge pressure, I'm just like, well, I'll come back tomorrow because probably will be green, maybe. I don't think that's going to be green, but I just know that, okay, the market fell. That's the red day. Okay, maybe it'll be a green day in the next couple days. Let me come back and see if I get a good green setup. I only short against monthly hedge pressure from the bottom. That's bear structure, and that's gamma hedging to the negative side, to the short side on the monthly scale for long-term institutional positions. I definitely want to side up with them and short off a monthly hedge pressure. Those are clean shorts. You open below monthly on the S&P, you touch monthly from the bottom. I load up on a badass short, and I love that trade every time. That's your birthday? Jan 27, nice. Well, look at you, Illuminati controlling the market. I knew it. So, do y'all believe me that the moment you touch the DD band when it shouldn't touch? Now, what's the probability of that? We haven't directly measured it, but I'll tell you, in the history of the DD bands, it's only happened maybe 2 or 3 times, and the DD bands. Or what, from like a year, October? Doesn't happen that often. So it's a 90% chance that with a bullish DD, 90% chance that it doesn't want to touch that lower band. The market structure doesn't break. And if you touch that band, market gets a little crazy and it's random. And if you don't believe me on random, I told you all the mechanics that would happen before it happened. And these are the mechanics. That the VIX itself would start to widen because the VVIX will go up, and that the stock market itself will start to experience a little bit of curvature, and it'll be random in one direction, and you can't forecast what it's going to do. Do we all agree on the curvature there? You understand what I mean by curvature? The highs are getting, well, let's put it right on point here. Let's just measure the peak of these highs. Let's draw like a straight line from here to here. You see how it's blasting even faster and faster above that line? Does everyone see the curvature? The minute you touch this band, you understand it's curving one way or the other. And volatility is going up. And then I say the volume's no longer going to be a clean J-shaped volume distribution like you normally will see a volume distribution like this. From the moment in time you touch the band, from here, volume's going to be erratic. Look at volume going up and going up and going up and coming down. Look at this high volume. The distribution looks like this. It's like, what's going on? Isn't that neat? That you can forecast all of that from 5 o'clock yesterday. If I touch this band, okay. The worst could have happened is that this could have happened, right? Or this could have happened. This could happen. Either one of those are possible. And anything is going to be random in the middle and up and down. It's going to do a lot of stuff. The curvature is very evident. You can see that if you were to draw a line between these peaks, it certainly is curving. I just draw a straight line so that you can see the curvature against it. This is a relationship of the VVIX going up, which is predictable. When this happens, volatility starts to go up and down rapidly as people are rapidly hedging. When volatility is getting bigger, the VVIX is going up, which means the S&P is likely going to experience curvature. And that happens the moment you touch this, when it shouldn't. When the DD number ratio, again, repeating, is 0.7 right now, 0.76. Stocks are really bullish, and the index is not. So it looks like somebody got squeezed on the index while the stocks are holding the fort. And as I said, stocks are here with the DD, index is down there with resilience, holding its gap down. They are going to collapse somewhere in the middle. So if the stocks start falling down, the index will also probably like forecast and trade against it, and they're going to start to collapse at the bottom. If the index goes up, stocks will go up, and it will do this and then start to collapse together. Or they just meet in the middle. And which one wins? Well, it's random. So from this point in time forward, it is random. Which one collapses into the other? Don't know. Don't try to guess. What kind of valuation account is recommended for the first time? Static drawdown every time. That's the only type of account that's worth doing, in my opinion. The quickest turnaround to get you a funded account in ETF, like a 5-day turnaround. Static drawdown is in my opinion, the easier of the two. It's one parameter you have to watch. So it makes it easier. And it doesn't trail. So whatever it is whatever it is, which basically means your first trade is your most important trade. You got to lift off the starting line enough that you're not risk of blowing out. Now, trailing drawdown, you might get a little more fat out the start. You can lose a few more days to begin with. So trailing drawdowns, the benefit is you can immediately start trading and you can have 2 or 3 bad days. Static drawdown, I treat it like my first trade has to be perfect and I wait for it. That's the downside. But if you blow up, the turnaround is quick. It only took me 5 days to get one. I did 2 of them back to back, 5 days, did another one in 5 days. Static drawdowns are probably the easier ones to do. The other two, if you have like a daily loss limit, then as your account grows, it fixes how much you can win as well. If your daily loss limit is a certain amount, then your risk never goes up. Your risk stays the same. You can't risk more as you make more because you have a fixed loss limit no matter what. If you have a static drawdown, it anchors in place, and as you grow above it, you can take more risk up to the maximum they give you. The static drawdowns, typically they give you fewer contracts. At the end of the day, drawdown that I had was a $250,000 account. They gave me up to like 24 contracts or something to trade. That's ridiculous. I only traded like 3. Static, they give you a total of 4, which is more appropriate for what you'd want to be doing. So in my opinion, the stack's the way to go. Anyone else here doing funded accounts? Do you have opinions about that? What are y'all's favorite? What are y'all's favorites to do? Static is the fewer. It requires you to be more patient, but the reward is there's fewer parameters that you need to monitor, and you can build a buffer off of your loss, which means if you're patient and build that buffer, it gives you plenty of time to give yourself a head start so you can have a bunch of losing days and still stay in the game. That's my opinion on the whole thing. So I don't know, what do y'all think? Is this my first time to ever do it? My only time I'll ever do it as well. And I always think of everything, so I'm always trying to be like 10 steps ahead. It's very cool. We don't really have any critics, I would say, because I try to do everything the right way. And I was like, I'm gonna do one of these things. And I know if I do it, somebody's gonna say, oh, it was a fluke, or oh, he just got lucky, or whatever. So actually from the start, like I always try to think ahead. Like traders, your goal is to always think ahead. So I'm like, okay, let me do one, and let me do another one too, and let me do another one. Let me just do it 3 times. And let me just not say that I just mastered one of them like the static. Let me just do a random one too. Okay, let me do this end of the day drawdown. It's a little different. I set up 2 strategies for both of them. I made a thing, so I can find it. And so I beat the static twice. And beat the end of the day one. And I make something that looks like this to plan how I'm going to do it. I teach a class on how to do it. My max contract size is fixed based on the risk interval, which is all this DD band talk we're talking about. My win rate determines how many days to completion, et cetera, et cetera, et cetera. Oh, wait, hold on. This is actually, I was changing. This is actually not the correct win rate. This is linking the wrong cell. Hold on. That's actually my 250. So I actually, here, this is the one for the 250 as well. It was actually just copying and reiterating those numbers. But at the end of the day, drawdown, I set up the parameter, daily loss limit, and I do these stats there as well. How did I must have just been doing this too quick. Let me make sure I get that right. W40. Oh, that's right. So you only need, I think it's 4,000. Let me do it because I was trying, that was the 150,000 target. The max profit target is 4,000. So let me redraw this. I'll give you the numbers. I had 15,000 in that cell instead of 4,000. There we go. I was wondering why that was different. That's how I do it. And you plan out all the different parts of it based on your win rate. My win rate is about like 73, 74% right now for this year. Oh, my bad. No, you can't see anything. I'm such an idiot. Hold on. I'm talking to myself here. See, I get a little tired in the mornings. Let me do this. Days to win. Okay, let me show you the thing I made. My bad. All right. So I made this spreadsheet. Yeah, and there are classes on how to do this. So I have part of our curriculum here. So I made also, somebody talks about this Robbins Cup thing. It's like the Trading World Championship. I'm going to enter it in June. As soon as we get futures trading and Rocket Scooter, I'm actually going to enter it in the middle of the year and still win it. I'm literally going to win that thing hands down. I'm up 500-something%. I would literally be in first place with my 10K account by a long shot. So I will enter it and I will win it. Hopefully. Or not. Maybe I won't. Hopefully I'm going to aim to win it. I'm going to try to win it. Just because